And welcome. You are listening to, and perhaps even watching, the Financial Survival Network. I'm Kerry Lutz. Today is 12/9/2020. Well, we still have election uncertainty, electoral uncertainty. We've got markets that seem to like it all. And, well, we've got a case coming up to the Supreme Court that could be Dred Scott Part 2. If you know a little bit about history, Dred Scott case is credited with by the Supreme Court's lack of political savvy for actually triggering the Civil War. Will they have learned from history? Well, let's get these questions answered and more, but I'd like to get your opinion. Why don't you send me an email, kl@kerrylutz.com. That's kl@kerrylutz.com. Without further ado, here's our good friend, Michael Pento. And Michael, it's great to have you back on. And hey, I guess you've been making money lately, huh?
Thanks for having me back on, Kerry. Yeah, we had a very good year so far this year, myself, my clients in the inflation, deflation, and economic cycle portfolio. But when the total market cap of GDP rises to 185%, you have to worry about keeping your capital. You have to be very vigilant, and that's what we are here. So we kind of have a way of riding out these bubbles, but there's landmines coming up in 2021, in my opinion. And maybe they'll be avoided, maybe they won't, but my model tends to treat the market like a scientist would. We measure and map some of the vital interior components of it to let us know when to get out. And we're looking basically for the second derivative, a change in inflation to deflation or inflation to disinflation, or from growth to recession or depression. And that's when we can avoid big drawdowns in the portfolio. You have to avoid the big drawdowns. So for example, 2000 or 2008, or maybe even the Russell 2000 in the fall of 2018, or even in January, February, March of 2020. If you can measure and map those changes and get out, maybe even short the market, that makes all the difference in the world. So we're happy to have that process and apply it.
Yeah, and rightfully so. I mean, look, we got the prospects of a second stimulus coming. That's going to be great for the Robin Hood effect. But Michael, these Robin Hood traders, and I should also mention that you should go to pentoport.com to check out Michael's site and find out more about his podcast, get his book as well.
Kerry, can I just say something? I mean,
Sure.
I just say something. You mentioned the second stimulus. You remember the angst in 2008 when the first $700 billion TARP vote failed and the market tanked? $700 billion, Kerry.
Right.
We already passed $3 trillion in stimulus in 2020. And now the fiscal hawks in DC, if there's any left, have agreed to another additional $900 billion deal. They're quibbling between, some protections for businesses and the funding of state and local governments. But we're going to have I'm very much convinced that both parties will agree for they call it a down payment. This is the $900 billion, which is bigger than $700 billion, I believe, right? And on top of the $3 trillion, that's a down payment, Kerry, to take us to January 20th, when I believe, I mean, rightfully or wrongfully, I'm not going to make any political statement here. I believe that Joe Biden will be elected president, even though I didn't vote for him, because I just see the local courts, the state courts, the Supreme Courts are just turning down all of these objections from the Trump administration. I just try to deal in reality. It's not, I don't invest for what I hope would have happened, or I don't invest for what I think someday could happen. I want to know where I can make money in the near future, now and in the near future.
Yeah, and realistically, as a recovering attorney, I totally agree with you. I think the die's been cast, and look, you got to accept reality, which means we're going to see many more stimulus bills. Everybody's going to get bailed out because, Michael, the choice is massive bailouts or massive bankruptcies. And at this point, does it matter?
Oh my God, it's massive bailout. So what you just hit on, Kerry, it matters intensely. If you get massive bailouts, then what happens to the second derivative of inflation and growth? You get this temporary artificial boost in inflation and in growth, but you haven't fixed the underlying problem. We eventually have a very serious problem to deal with, not only in this country, but across the globe. I wanted to just touch on one thing for you. Do you remember back in 2012, do you remember the pigs? Remember that, right?
Of course, yeah. Portugal,
Italy, Ireland, Greece. Do you remember? So let's just take an example.
Right. Yeah.
So Portuguese debt was 132% of GDP in 2012, debt to GDP ratio, 132%. And during that crisis, this is before Mario Draghi came in with his bazookas, firing all over the place. That debt yield on the 10-year note went up to 15%, 15%. Do you know what that the yield is today on a 10-year, going out 10 years? It slipped below zero.
Right.
In one of the pigs. So, and the debt to GDP ratio didn't go away. It's now 135% debt to GDP ratio. So what I'm trying to say here is that we're going further and further into the twilight zone or down the rabbit hole, whatever you want to say. And we have now remanded or relegated the entire economy and the entire market to central banks. They own everything. The ECB in 2021 will be purchasing 70% of all bond issuance on the sovereign debt level. 7-0, Kerry. We're there. So the ECB has become the Bank of Japan, and maybe we're to follow. But you're asked the question: if we let the economy function on a laissez-faire basis, so if the Fed stopped printing $120 billion a month, and if there were no more stimulus packages, we kind of have a, I don't say balanced budget, but we don't continue to increase the deficits by trillions of dollars per annum. What do you think is going to happen to the junk bond market? You know what the yield is in junk bonds now? It's less than 5%. It's 4.5%. So the spread to treasuries for junk bonds has never been tighter. The yield has never been lower. What happens when the treasury note yield starts to increase? What happens to the real estate market where you get a 30-year fixed mortgage now for under 3%, Kerry? Under 3%. What do you think those yields will do? The LIBOR will spike, the 10-year treasury yield will spike, mortgage-backed securities will tank, their yields will spike, and then you'll have a depression like we've never seen before. So modeling those dynamics between growth and recession is absolutely essential, not only to participate in the bubbles, but to get the hell out of harm's way when they crash.
Yeah. So 2021, and correct me if your opinion's different, going to be a year of tremendous volatility, isn't it?
Well, I could tell you this thing. I agree with you 100%. I've never seen the endangered species of bears more prevalent than it is today. I can't really find many people who are bearish. And by the way, I'm not bearish right now at all either. So, but here's the difference between me and most people. I'm not a perma bull or bear, but the amount of perma bulls on Wall Street is rising exponentially. Everybody seems to agree on this construct to the market. So we have the vaccines. The economy will be much better in 2021 than in 2020. The Fed will be at 0% till at least the end of 2023, and they will continue supporting the stock market with massive and record amounts of QE. And the economy is going to be, booming because of that. Booming. You hear some of these growth forecasts for the entire year, 6-8% GDP growth next year. I mean, that's possible, Kerry. It's possible if everything goes right. But what if the vaccines don't work as advertised? What if no one takes the vaccines or very few people take them? What if there are side effects? What if the vaccine doesn't last very long? What happens if there's problems with delivery of the vaccine? What happens if there isn't a seamless transition of power on January 20th? These are all the things that I'm looking at and modeling. But the most important thing I have to worry about in 2021 is if the economy heals and if inflation approaches that 2.5% on the core PCE deflator, the Fed's, holy grail target, and then you get Jerome Powell attenuating his purchases of bonds, treasury bonds, corporate bonds, junk bonds, immunity bonds, then you might have a spike in yields like we had in 2018, or even like we had in 1987. And even though the economy looks good for a while, without those supports of massive bond purchases from the Fed, you might see a spike in yields that just throws the whole thing into turmoil. So that's what I'm most concerned about, and I'll be modeling that very carefully.
Well, this reminds me, so the Fed has these indices, these measures that spell out inflation and everything else. And I remember there was a pharmaceutical convention one time, many, many years ago. This is like 20 some odd years ago. And at the time, there was all these different additives they said caused cancer. And they asked one pharmaceutical food additive company executive what he thought was necessary to get things straight. And his prescription was, what this country needs is a stronger white rat, because that's who they test all the stuff on to see if it's going to affect humans. And I think that's what the Fed's solution will be. Their idea of a white rat are their measurements, which they can easily adjust and adjust inflation away so that it doesn't even exist, right? Do you think they won't hesitate to do that?
Well, of course, their history is replete with examples of government changing the calculation for inflation, but that won't fool the bond market investors. That's the thing. In the end, I believe the market, the free market, whatever's left of it, is going to win. So, look, if the inflation rate starts going to 2.5% on the core PCE deflator, then you better believe it's closer to 10% in reality, and that's not going to escape the whatever is left of the bond vigilantes out there. That's my firm belief. And you start seeing, the middle class being hollowed out further, and you'll see commodities spike, college costs, real estate costs, bond prices, asset prices. We had an IPO today, DoorDash, genius idea this is, someone is delivering food from restaurants. Very, very, fancy idea here. I'm surprised no one ever thought of it. But the IPO, it's up 8 as of the recording. It just went out in one day. It's up almost 90% in one day from the IPO price. I mean, this is emblematic of the bubble created by central banks. And there is going to be hell to pay. You just want to be on the right side of the trade when it happens.
Yeah. So this insanity, like, you cannot make money delivering food. All right. These companies have only lost money. There's a few of them out there. Airbnb, I will grant you, that was super profitable before the pandemic and probably will be after, because the middle class won't be able to afford to stay in a hotel anymore, and they'll have to go seek alternative lodgings. So the future might be bright for Airbnb, but at what price? And this idea that, look, if you can't make money delivering people door to door like Uber and Lyft, why is delivering their food going to be any more profitable? I've used them before because they gave me big credit, cost of consumer acquisition. I was a beneficiary of it, and their service is fine. The food came quickly and hot, but then it's like, oh, well, you know what? We don't really like to clean our bathrooms. Maybe we can have a bathroom dash, and they'll just clean bathrooms of restaurants. So they'll subcontract that out. What are they worth? Right? What's the bathroom bash worth?
Well, here's the thing. Thank you for making me laugh today, by the way. Here's the thing. Does anybody care anymore if DoorDash makes money or any company on Wall Street any longer. You know, this is true. This is not my data. Wall Street Journal came out with this story. 40% of all listed companies in the United States don't make any money at all. And 20% of these companies are called zombies. They can't, forget about making money, they don't even have enough revenue to pay interest on the outstanding debt. They have to raise new debt to pay the interest, not the principal, the interest on existing debt. The debt of zombies is up 270% this year alone. These are all the monsters. These are the progenitors of the Federal Reserve. And we have to reconcile these imbalances someday, soon. And that's what we're all about here at Pento Portfolio Strategies, and what you try to do also with your ties to precious metals. People have to have a hedge other than the typical 60-40 portfolio that the deep state of Wall Street likes to purvey on people. Because it doesn't work when bonds, $17 trillion worth of sovereign debt around the world has a negative sign in front of it. So when the bond collapse comes, it's going to cause the stock market to collapse around the world, and you will have nothing, no ballasts, nothing to offset your portfolio other than the ability to own gold or go into cash or short the stock market. That's it.
Yeah, and it's going to be a hell of a short. And that reminds me of, can't remember his name now, the Black Swan guy, Nassim Taleb, right? And it's like, kind of usually, like if you go into a casino and you keep increasing the size of your bet, hoping that you're going to win, you're going to lose, because that's called the gambler's fallacy. But Taleb, on the other hand, is like, this thing has to happen. It's going to crash. You can keep increasing your levered bets on the eventual demise, and eventually it's going to happen.
Yeah, Kerry, this is true because all of Wall Street is on the same side of this big, beautiful trade in 2021 of a return to normalcy. Let's not forget what 2019 really was like. It wasn't any kind of booming economy. The year-over-year growth rate in 2019 was 2.2%. That's it. BEA.gov if you doubt that figure. Okay? So the economy was not booming, and we achieved 2.2% growth with the help of a Fed that had to cut rates 3 times between the summer and the end of the year, 2019, and had to return to quantitative easing to keep the repo market afloat. So 2019 was not a fantastic stock market or a fantastic economy. We returned to a normal state. I don't see how you can return to even that anemic normal state because of all the scars left behind from COVID-19. We just went through some of the scars already. $17.5 trillion of the total non-financial business debt. That was just $10 trillion when coming out of the Great Recession of 2009. So we piled on a tremendous amount of new debt that we have to lug around, that we have to service. There's a tremendous amount of people that are now become permanently unemployed. A lot of businesses have closed their doors permanently. So the big surprise in 2021 could be that the economy isn't all that great. It wasn't great prior to COVID. It isn't great coming out of COVID. The vaccines don't work that well, or everything does work just perfectly, and the Fed begins to lose control of the long end of the yield curve. It's one thing, Kerry, just so you know, in context, between the end of the 1950s, early 1960, all the way to 2000, Bloomberg did a study on the average bond yields, 7.3% on the 10-year note. That's the average bond yield before the Feds decided they can control the long end of the yield curve. What if if we were going from 5% to 6% or 7% on the 10-year note, that wouldn't be much of a problem. When you go from 0 point something back to 4, 5, 6, 7%, 15% where it was in 1981, that's the real problem. That's the reconciliation still to come. And you don't want to be anywhere near the stock market when that happens.
Yeah, so the Great Reset could well be the reset of interest rates that brings everything down around the globe, because it'll be cascading defaults from Main Street to Wall Street to every street on the planet.
Very true. Very sad, but very true.
Right.
And the buy and hold mantra from the deep state of Wall Street is not going to help you. You've lost, for those of us who are approaching retirement, still have, maybe a decade or so to go. But for those approaching retirement, to be facing another, say, 83% drawdown in the NASDAQ, like they had in the year 2000 to 2002, or to lose 50% in the S&P like you did in 2008, or to get another 30% drawdown in the Russell like you did in the fall of 18, or to get another 30% drawdown in stocks in a matter of weeks like you did in 2020. You have to worry not only to avoid those big drawdowns, but are you so sure that those rebounds are going to come roaring back? If it happens again, the Fed is already close to zero, at zero, in fact. I don't think they'll be anywhere off zero until 2024. And the Fed is already printing money. If we have another cataclysm in the stock market, for any of the various reasons that I just mentioned, what is the Fed to do? Are they going to cut interest rates 500 basis points like they have needed to in the past to get us out of recession? That room isn't there. Are they going to have to start, resorting to quantitative easing? Well, they're already $40 billion more per month than they were in 2008. So you might not get that automatic slingshot rebound like you had in 2020, and you can't wait 7 or 8 years like you did in 2008.
Yeah, and that's really worrisome. It's the analogy of the drug addict that keeps needing more and more heroin, or the alcoholic who needs more booze just to get straight, not even to get high, but just to maintain some semblance of straightness, is really apropos here. And at some point, you get to the point where they need so much that it's just going to kill them. And I guess we're going to approach that point. So precious metals and strategic allocation of your portfolio, probably the ways to go here.
Yeah, I wrote this in my book. It's like trying to stay drunk constantly to avoid a hangover. I don't think that's going to work.
No, we know that. Yeah.
So you have to strategically allocate your portfolio. You have to measure and map the dynamics of deflation, inflation, growth, and recession. And that is the best thing you can do, because you can't sit, you have to be the Fed is forcing you in the stock market. What part of the stock market do you have to go in? When do you switch from bonds to growth stocks, low volatility to high volatility? What sector do you want to invest in? Is it utilities and real estate, or is it in Russell 2000? Makes a huge difference. But most importantly, like I said, when do you get out? That's crucial. If you can find someone that has a pretty good track record of doing that, that's a home run.
Hey, my mother always said, making money is often the easy part. Holding on to it is really the hard part. And I've experienced that firsthand in my life. And it's nice to find somebody with a philosophy that kind of revolves around that conundrum.
Thank you, Kerry.
So anyways, you got to go over to Pento, P-E-N-T-O, port.com. And otherwise, how do people stay up on your thoughts, Michael?
So I have a weekly missive called the Midweek Reality Check. You can find that on my website, pentoport.com. You can call the office at 732-772-9500. My email address is mpento@pentoport.com.
All right. Any questions for Michael, myself, your opinion on this? We'd love to hear what you think. Just send us an email, kl@kerrylutz.com. Go to our website, sign up for your free weekly newsletter. That's financialsurvivalnetwork.com. Michael, thanks so much for taking time out for your busy day to share your wisdom with us. And we will talk to you again real soon.
Always a pleasure, Kerry.